If anything should happen tomorrow, what would your family need on Monday morning? Not a year from now. Not once things settle. Monday. Because here's the part most people never think through until they're forced to. Grief doesn't put the mortgage on hold. The funeral home doesn't say, pay whenever you're ready. The school doesn't waive tuition because your world just broke open. The car note still hits on the 15th. The utilities still come due. The grocery bill doesn't stop. And while your family is trying to do something as basic as breathe, somebody has to figure out how to keep the entire life you built from collapsing financially. That isn't a gloomy thought. That's a real-life Monday. And the reason life insurance exists, the reason it was created and the reason it's still around centuries later, is so that on that Monday morning your family doesn't have to choose between mourning you and making rent. Welcome to Wiseside Life and Legacy. I'm your host, and this is where we start. Before we talk about term, whole life, universal life, riders, cash value, living benefits, or any of the other language that gets thrown around, before we talk about a single product, we've got to talk about the why. Because if you don't understand why life insurance exists, you'll never choose the right kind. You'll end up buying what someone pushes. And that's how people get underinsured, pay too much, or worst of all, discover they're not covered when it actually matters. So today, we're going back to the beginning. This is episode 1 of Wiseside Life and Legacy, a podcast built for one purpose, to teach life insurance clearly. Not to pitch you. Not to steer you into a particular carrier or a shiny illustration. The goal here is education, so you can protect the people you love with your eyes open. Here's what this series looks like. Over the next 24 episodes, we're walking through the full life insurance universe. Term life and all its variations. Whole life. Universal life. Indexed universal life. Variable life. Final expense. Group coverage. Survivorship policies. Living benefits. Riders. Trust planning. Business use. Estate strategy. Nothing gets skipped. Some episodes will be just like today, you and me, one concept at a time, plain language, no fluff. Other episodes will bring in licensed underwriters, financial planners, estate attorneys, business specialists, and families who've lived through the moment when a policy either did its job, or didn't. Because life insurance isn't theoretical. It shows up in the most human moments of someone's life. Each episode will run about 25 to 30 minutes, long enough to actually teach, short enough to fit into real life. And every episode ends the same way, with one clear action you can take. Something you can do this week, sometimes today, sometimes right after this ends. In this episode, we're covering 5 things. First, the original purpose of life insurance, what it was built to do. Second, the difference between income replacement and legacy creation. Third, how insurance companies afford to make these giant promises. Fourth, the "I'm too young" myth, and the math that makes waiting expensive. And fifth, the 4 life events that should always trigger a policy review. Let's get into it. Start with the cleanest definition possible. Life insurance is a contract. You agree to pay a company a relatively small amount of money over time. In return, that company agrees to pay the people you name a much larger amount of money when you die. That's the whole deal. If you strip away the marketing, the product names, the acronyms, and the charts, you're left with something simple, a promise. Small payments now. A big payment later. To the people you choose. When you can't provide anymore. Now, where did that idea come from? Because most people assume life insurance is some modern invention cooked up in a boardroom. It isn't. Versions of life insurance go back roughly 2,000 years. In ancient Rome, soldiers formed burial societies. Each person contributed a little into a shared fund. And when someone died, that fund covered the burial and helped the widow and children. They understood something brutally practical. a single household could be destroyed financially by the loss of an earner. But if enough people shared the risk, if the burden was spread out, then no one family had to carry the full weight alone. That's the seed of everything we call life insurance today. Fast forward to 1700s London and you see the first versions of what we'd recognize as formal life insurance companies. By the 1800s, mutual insurance spreads across Europe and America. By the 1900s, life insurance becomes one of the pillars of middle-class financial planning, right alongside a mortgage and a savings account. So when someone tells you life insurance is new, or they act like it's an untested concept, remember, humans have been using this idea for about 2 millennia. Now, let's get crystal clear on something else. Life insurance is not a magic money machine. It's not inherently an investment. It's not primarily a retirement plan. It's not a clever loophole. Yes, some types of life insurance can include cash value. Some policies connect to market performance. Some can support retirement strategies in specific situations. We'll talk about all of that later, in detail. But the core purpose, the reason the contract exists, is risk transfer. You're taking the financial risk of your early death and moving that risk onto a company designed to absorb it. And here might be the most important mindset shift in the entire episode. Life insurance isn't really for you. You're not the one who benefits from the death benefit. You won't spend it. You won't enjoy it. Life insurance is for the people whose lives are tied to yours. Your spouse. Your children. Your aging parents, if you help support them. A business partner. A sibling you quietly assist. Maybe even a charity you care about. The point is this: if someone depends on you financially, even partially, life insurance is a way to keep your promise to them even if you're not here. And once you internalize that, everything gets clearer. Because instead of asking, "What's best for me?" you start asking, "What protects them?" That's a better question. It leads to better decisions. Now that we've defined what life insurance is, and who it's for, let's talk about the 2 jobs life insurance can do. 2 jobs. That's it. All the complexity in this industry is basically different ways of doing one of these 2 things. Job 1, income replacement. Job 2, legacy creation. Let's take them one at a time. Income replacement is the original assignment. The foundational reason families bought life insurance in the first place. Here's the reality. If you earn money, and your household relies on that money, then your death doesn't just create emotional loss. It creates a financial vacuum. So life insurance steps in and fills that vacuum. Picture a simple scenario. A parent is 35 years old and earns $75,000 a year. There's a spouse, 2 kids, a mortgage, car payments, everyday life. If that person dies, the family doesn't lose $75,000 once. They lose the ability to earn it year after year. If there were 30 working years left, that's potentially over $2 million of earning power, gone instantly. Now, can the surviving spouse work? Sometimes. Often they already are. But here's what people underestimate: replacing an entire income while also parenting alone, keeping a household running, handling childcare, and trying to function through grief is not a simple, just get a job, situation. So the family needs a bridge. A way to keep the home. A way to buy time. A way to keep the kids stable, same school, same routines, same neighborhood, while life is being rebuilt. That bridge is usually what term life insurance is designed to be: straightforward, affordable coverage for a specific window of time. 20 years. 30 years. The years when people depend on your paycheck. And if you have dependents and you don't have enough income replacement coverage, that gap is bigger than most people want to admit. Bigger than a missed retirement contribution. Bigger than not having the perfect emergency fund. Because those plans assume you're alive. Income replacement is the plan for when you aren't. Now let's shift to job number 2, legacy creation. Legacy creation is not about replacing what disappears. It's about creating something additional, something that might not have existed otherwise. If income replacement is defensive, legacy creation is aspirational. It's saying, I want my death to provide a financial gift, not just prevent a financial collapse. Here's an example. Imagine a grandmother who's 65. The house is paid off. Her children are grown. Nobody relies on her paycheck. Does she need life insurance for income replacement? Probably not. But she buys a permanent life insurance policy because she wants each grandchild to have $100,000. Or she wants to fund a scholarship. Or she wants to leave something meaningful to her church. That's legacy creation. And it's usually where permanent policies, whole life, universal life, and variations, tend to show up. They cost more, they're built to last, and they're designed for that long-range purpose. Here's what surprises a lot of people. Many adults will need both, just at different stages. When you're building a family and a career, income replacement is the priority. Later, when the mortgage is smaller or gone, when kids are independent, when the fear of collapse fades, you might still want to leave a gift. That's legacy. Income replacement protects what is. Legacy creation builds what could be. Both are legitimate. But they're not the same conversation, and they shouldn't automatically use the same type of product. As we go through the rest of this series, we're going to keep asking one simple question: which job are we hiring life insurance to do right now? Now for the part most people never get a clean explanation of: how insurance companies afford to make the promise. Because if you're sitting there thinking, how can I pay a few dollars a day, and they'll pay my family hundreds of thousands of dollars, that's not a foolish question. That's the right question. Here's the plain English version. A life insurance company is basically three systems working together. First, it's a massive pool of money. Second, it's a risk calculation engine powered by actuaries. Third, it's an investment operation that steadily grows what it holds. Let's walk through it. The pool is simple to visualize. If 1 million people each pay, say, $100 a month, that's $100 million collected every month. Some of that pays the company's costs, employees, technology, customer service, compliance, all the operational stuff. Some of it goes straight out the door for claims this month, because every month, people die and beneficiaries get paid. And the rest goes into reserves. Reserves are not just extra money. They're a legally and financially managed reservoir set aside to pay claims in the future. And yes, this is heavily regulated. Insurance carriers are required to hold substantial reserves. They're monitored, audited, rated. A strong insurance company is designed to be boring and stable, because families count on them decades from now. Now let's talk about the actuaries. Actuaries are the mathematicians who live in the world of probability and large groups. They're not predicting your exact death date. No one can do that. What they can do, with startling accuracy, is predict that out of a huge group, say, 1 million healthy 35-year-old non-smokers, a certain number will die in year 1, a certain number in year 2, and so on. This is the law of large numbers. The bigger the group, the more predictable the outcomes become. Once actuaries can estimate how many claims will happen and when, they can calculate how much needs to be collected in total to pay future claims, cover costs, and keep the company healthy. That's where your premium comes from. Not from a salesperson's mood. Not from negotiation. It's math. And then there's the third piece, investing the reserves. The company doesn't take all those premiums and keep them in a vault. They invest them, typically in conservative places, bonds, high-quality corporate debt, real estate, and other regulated investments. Those returns help the company keep premiums lower than they would otherwise have to be. And in some policies, certain kinds of returns can be credited back into the policy structure. That's part of why products like universal life, indexed universal life, and variable life exist, and we'll unpack what's true, what's hype, and what's risky when we get there. But the core engine stays the same. Big pool. Predictable math across large groups. Reserves. Conservative investing. That's how the promise is funded. So when you pay a premium, you're not throwing money away. You're purchasing a contract backed by a system that has been refined for centuries, designed for one job, to pay when the day arrives. Now let's make this practical. Because a lot of people listen to an episode like this and think, okay, I get it, but when should I actually do something? Here are 4 life events that should always trigger a life insurance review, either a new policy, more coverage, or at least a serious look at what you already have. 4 triggers. No exceptions. Trigger number 1, marriage or a committed long-term partnership. The moment you build your life with someone, your finances become intertwined, even if you keep separate accounts. Your rent, your mortgage, your plans, your lifestyle, your shared responsibilities, those things now touch both of you. Life insurance becomes one way of honoring that commitment. If I'm not here, you won't be financially crushed on top of emotionally devastated. If you're newly married, the review shouldn't wait 5 years. Do it within the first year. Trigger number 2, a child enters your life. Birth. Adoption. Foster care. Becoming a step-parent. The second you are responsible for a child, the stakes change. Because now your income isn't just supporting a household today. It's feeding a long runway of future needs. Raising a child isn't a short-term project. For most families it's an 18 to 25-year financial commitment. And when you look at the total cost, food, housing, childcare, healthcare, activities, transportation, actual life, it adds up fast. So if you are a parent and you don't have adequate life insurance, this is not a later task. It's one of the most urgent protection gaps you can have. Trigger number 3, a major asset or a major liability. Buying a home. Taking on a mortgage. Co-signing something big. Personally guaranteeing a business loan. A mortgage is a long promise. If you sign that promise, your coverage should be strong enough that your family doesn't have to sell the home because you died. And if you've personally guaranteed business debt, if your death would shove that burden onto your spouse or estate, then matching coverage to that obligation isn't optional. It's responsible. Trigger number 4, a major change in income. When your income rises, your lifestyle usually rises with it. The coverage that made sense when you earned $50,000 often doesn't protect the reality of a household living on $150,000. Protection should scale with the life it's protecting. And it goes the other way too. If your income drops significantly, career change, early retirement, business downturn, you might be overpaying for coverage that no longer matches your needs. Either way, income changes should trigger a review. And I'll add a quiet bonus trigger, even if nothing dramatic happens, review your coverage every 5 years. Life changes in small ways. And 5 years is plenty of time for small changes to become huge differences. Before we close, we have to deal with one myth, because this myth is expensive. It's not just wrong. It costs people real money, and sometimes it costs them the chance to get insured at all. The myth is, I'm too young to need life insurance. Let's talk with numbers, because numbers don't care about vibes. A healthy 25-year-old can often buy a 20-year term policy for $500,000 for something like $20 to $30 a month. 10 years later, at 35, that same person might pay $35 to $50 a month. At 45, that number might jump to $80 to $120 a month. And that's assuming health stays perfect. But health doesn't usually get cleaner with age. Between 25 and 45, a lot of adults pick up something: high blood pressure, cholesterol issues, weight gain, sleep apnea, a diagnosis they didn't expect. Even one change can move you from a top-rate class into a more expensive category. And that can double or triple your premium for the same death benefit. So the person who says, "I'll do it later," often ends up paying far more for less coverage. Or they find out, later, that they're no longer insurable. If you are young and healthy right now, that is an asset. You can lock in low cost when the odds are in your favor. And if you're not young anymore, don't let that stop you. The next best time is still today. Because the calendar keeps moving. The price tends to rise. And the window doesn't usually get wider with time. Let's bring it all together with one big takeaway. Life insurance is not about you. It's about the people who would be left to carry the financial weight of your absence. If you remember that one idea, the rest of this series will make more sense. Product comparisons will get simpler. Decisions will get clearer. Because the question won't be, what can I get? It'll be, what do they need if I'm not here? So here's your action step for this week. It takes 2 minutes. Open your notes app or grab a piece of paper and answer one question: whose life would change financially if I were gone? Write down the names. Your spouse. Your kids. Anyone you support. A parent you help. A business partner who depends on you. Any person whose financial reality would shift the day you were no longer part of it. That list is your why. And that's what we're protecting, through every episode that comes next. Keep the list. We'll come back to it. Next week on Wiseside Life and Legacy, we're doing episode 2, The Language of Life Insurance. Think of it as the decoder ring. We'll break down the terms you have to understand to make sense of any policy or illustration: premiums, beneficiaries, riders, cash value, surrender value, and more. So when someone puts paperwork in front of you, you'll actually know what you're reading. Until then, take those 2 minutes and make your list. Write down the people who depend on you. Because that list is your legacy. And protecting that legacy is what this entire series is about. I'm your host, and this has been Wiseside Life and Legacy. Educate. Empower. Protect your legacy. I am your host, Nakel Nakima. We'll see you next week.